A pleasant day, Ms. Luzon. Here in front of you are Cluster 4, and we're here to present the Module 5 report on derivatives and hedging. Our focus is AAPL Incorporated, AAPL on NASDAQ, specifically analyzing its earning risk ahead of its supporting full FY 2026 report that came from 13/2026.
Using a leading market data from March 10, 2026, a stock price of $256, a put strike of $267.50, a tiny premium of $11.80, we built a real evidence-based derivative analysis. Applying Newton's sense from Ryan Brown, such as option payoff formulas, put low parity, and protected put strategy, we evaluate how derivatives can manage earnings uncertainty.
Our essential question: given AAPL's earnings risk, which derivative strategy offers the best downside protection?
So we walk you through our analysis, our assumption, the reason, the recommendation.
So I am Hadeline Sia Polinar.
I am Jan Cassandra M. Galasio.
I am Galice J. Lancel.
I am Zana R.J. Lea Sustana. I am Daisy M. Lutiel.
And I am Lizzie Vergara Halunan.
Let's proceed in discussing the Module 5.
Good day, everyone. We are looking at Apple Incorporated ahead of its Q2 FY 2026 earning announcement scheduled for April 30, 2026. Earning dates are critical risk events. They create significant uncertainty in stock prices and are exactly kind of situation where the derivatives become more valuable. To give you a sense of scale of what we are working with, Apple reported their Q1 FY 2026 with a revenue of $143.8 billion. They beat the EPS estimates $2.84 per share. So our hedging strategy, we selected the put option with a strike price of $267.50, which was the most actively traded Apple put contract, with over 40,000 contracts traded, representing the true market consensus on where downside risk lies. At the time of our analysis on March 10, 2026, Apple was trading at $256. So the question is, how do we protect a portfolio holding these stocks from a potential post-earnings declines? So that's what exactly the next slides will answer. Now, we are going to discuss the payoff formulas that form the mathematical foundation of our analysis, directly referencing Riley and Brown's framework. We examine the three types of instruments: the futures, the call options, and the put options. First is the futures. The long futures payoff is simply S times T minus F times 0T, where the S times T is the stock price at expiry, and the F times 0T is the futures price original. Both parties are obligated to transact with no premium and no asymmetry. There is no optionality here. It is a symmetric instrument. Second, and most importantly, is the put options. The payoff is the maximum of 0 or K minus S times T. Plugging in our numbers, maximum times 0, which our K is $267.50, minus our S times T is the $256, give us the $11.50. After subtracting the $11.80, the net result is negative 30 cents, essentially break even.
So the third one is the call option. So the payoff formula is the maximum of 0 or S times 3 minus the strike K. In our scenario, the stock expired at $256, which is below our strike of $267.50. So the max of 0, 256 minus 267.50 is equals to 0. So the call expired worthless and the buyer lost the $5.24 premium. So this tells us that the put hedge was nearly perfect. It expired in the money and successfully protected the portfolio from a significant price decline.
Following Chapter 14.3 of Raylan Brown, we use put-call spot parity to confirm that our options prices were consistent with no arbitrage conditions. So the core idea is this. Two portfolios offering the same payoff must trade at the same price. From here, we tested four forms of parity using Apple data. First, as you can see, we have the put-call spot parity. Put-call spot parity sold for the call, giving us $0.40. And that makes sense because our call was deeply out of the money. Second is the solving for the put, which gives us $11.80 and no mispricing, no arbitrage. Third is the stock replication. Here, plugging all inputs back in recovers our original stock price of $256, meaning to say everything is entirely consistent. The fourth is the put call forward parity. Here, there is a theoretical spread that gives us $11.45 versus our observed $11.50. And as you can see, there is a 5-cent difference well within routing error. At this point, all four checks pass, and our prices are theoretically sound, and our hedge is built on a solid foundation.
So next is the protective put strategy. And I'll explain how we apply the protective put strategy as a form of portfolio insurance, directly referencing the Chapter 16.1 and Exhibit 16.13 of Rayleigh and Brown. So, the protective put strategy is the long put plus long stack. Together, they function as a insurance. And let us look at the two key numbers, which is the net cost of insurance. The stock price plus put premium, or $256 plus 11.80 is equals to 267.80. And this is the total cost basis of the protected position. Next is the floor price, or the downside call. Strike price minus put premium, or these $267.50 minus $11.80 is equals to $255.70. And this is the absolute minimum you will receive at expiry, no matter how far the apple falls. And looking at the P&L diagram, the green flat line represents the protective put. No matter where apple falls to 200 or to 180, the loss is still capped at 30 cents. That is what the $11.80 premiums buys you. And in contrast, the naked stock position bleeds all the way down, and put the option alone would be profitable. But only if you already hold the stock. Does the strategy make its full defensive sense? And lastly, the so what? Here is this. For $11.80, you bought yourself a complete downside protection going to one of the biggest risk event of the year.
So good day everyone. So I'll begin with the hedge ratio. So assume we hold 100 shares of Apple, currently priced at $256, giving us a total position of $25,600. So with an upcoming earnings announcement, there is a potential downside risk that we need to manage. So to address that, we use stock index futures, specifically the E-mini S&P 500 contract, and apply the hedge ratio formula, which is the N is equals to the market value of position divided by the futures contract value times the beta. So beta measures how sensitive a stock is to the overall market. As you can see here, Apple's beta is 1.24, meaning that it tends to move more than the market. So by applying the formula, we get 0.62, which we round up to 1. So this means that one futures contract is enough to hedge the position's market risk.
Moving on to hedging versus speculation. So consider two investors purchasing the same put option with a strike price of $267.50 and a premium of $11.80. So if one investor already holds an Apple shares, buying the put option becomes a protection. So that is an example of hedging. So on the other hand, if the investor does not hold any shares, the same put options became a bet on a price decline. That is an example, or that is considered as a speculation. So despite using the same put option, the purpose and the risk exposure differ significantly. So now looking at the actual outcome at an expiry price of $256. So for investor A, they expected a price increase and purchased a call option at a cost of $5.24. However, since the stock ended at $256, which is below the strike price of $267.50, the option expired worthless, resulting in a loss of $5.24. So for investor B, they used a protective put strategy. As the stock declined, the put gained value, limiting the loss to $0.30 after the accounting for the premium. So this effectively provided a protection or a downside protection. So the last one is for the investor C. They use a straddle strategy which they purchase both call and put option. However, at the given price, both options expired out of the money, resulting in a loss of $5.54. So for the summary, hedging is primarily used to manage and reduce risk, while speculation aims to generate profit but a greater uncertainty and exposure.
So let me briefly walk through the transparency of our assumption because model is only strong as a data behind it. First is the risk-free rate, which is a 4.50%. So we use the 10-year US Treasury yield for the week of March 10, 2026. Why do we use 10-year US Treasury yield? Because it is a global standard. It is what Greeley and Brown recommend. It also the Wall Street uses, and what are the formula, which is the CAPM, requires. So this rate was used in two places of our model. First is the discounting of put-call parity. Second is the baseline return of the CAPM. Next is the stock price, which is the $256. So we did not use the opening price. We also did not use the day before the closing price. So we captured the intraday price of the Apple at exactly 2:30 p.m. Eastern Standard Time. So on March 10, 2026, the same time we pull the option chain data. So why does it matter? Because if your stock price and your option price are from different time of point, so your model business will become insufficient or inconsistent. So we make sure everything is synchronized at the same moment. So next is the strike, which is $267.50. So here, we did not just pick a round number. So we look at the same entire AAPL option or Apple option chain for March 2026. And also, we identified the contract with the highest trading volume, which is 14,870 contracts. So in this, the market tell us where the most attention, the most money, and also the most concern, which is concentrated. So highest volume means consensus. So this meaning we follow the money. So next is the preview, which is $11.80. So this is the last trade of the contract, which is the AAPL 26313 for P00267500. So here, some of you might ask, why not use the bid as midpoint? So bid as midpoint was $11.80. So which only 9 cents different. So that is a material difference and does not change any of our conclusions. So we use the actual trade price because it reflects real transactions that happen in the market. So last is the market risk premium, which is the 5%. So this comes from Professor Aswart Damuradan of NYU STEAM, one of the most widely cited authorities on equity valuation in the world. So his early 2026 estimates for the US equity risk premium is 5%. So this is additional return investors. Demand for taking on stock market rise above the risk-free rate. So we use this in CAPM equations. So expected return equals is risk-free rate plus the beta time, which is the 5%. And also we need to discuss the time expiry. So our option expired in March 10. So that's why we gathered it on March 10. So that's only a 3 window. So now technically, AAPL option or Apple option are American style, meaning early exercise is allowed. But with only 3 days left and no dividends being paid in that window. So early exercise would not have been economically irrational. So this time, value remaining in the options was still worth holding. So that's we applied the European style treatment, which is the standard academic approach for the short-dated options, and it's fully supported by the Riley and Brown framework.
Every strong analysis must confront its own weaknesses. Here are the 4 risks that we acknowledge. First is the volatility spike or earnings beat. If Apple blows past more than $280 on strong earnings, our put expires worthless. The $11.80 premium becomes a pure cost. A bull case outcome means that the hedge was by definition unnecessary, but that is the cost of insurance you pay for the protection you hope not to use. Second is the model assumption breakdown. Put call parity assumes frictionless market and no dividend. The actual bid-ask spread of $1.05 represents a real execution cost that is not captured in our theoretical model, and this gap widens significantly in the fast, high volatility markets. Third is the liquidity or execution risk. Despite 40,000 contracts traded, the wide bid-ask of $10.90 to $12.90 still applies. In an earnings spike environment, slippage could push our actual entry from 11.80 to 12.50 plus, shifting the break-even point unfavorably. Lastly is the systemic or macro risk. If Apple blows past $280 plus on strong earnings, our put expires worthless. But unexpected macro events such as Federal Reserve decisions, geopolitical shocks, and China tariff escalations could affect Apple in ways no earning-focused put hedge can fully neutralize. We present this not to undermine our analysis, but rather to demonstrate that every derivative strategy carries trade-offs, and a skilled portfolio manager always knows where the model edges are. 3 different views on Apple going into earnings. Which strategy is right for each? Investor A is the optimist. They believe Apple will crush Q2 and rally $290 on iPhone and services strength. Their strategy is to buy a call option with a payoff formula of maximum time 0 ST minus K at 256 expiry maximum 0 256 minus 267.50 equals 0. The call expires worthless with a loss of $5.24. Investor B is the hedger. They hold Apple shares but fear SEER delays, FTC risk, and China tariffs, and could disappoint the market. Their strategy is protective put, with the payoff of maximum times 0, K minus S times T, at 256, maximum 0, 267.50 minus 256 equals 1150. Net after premium, negative 30 cents, near break-even, best outcome. Investor C is the speculator. They don't know which direction Apple moves but believes earning will trigger a massive swing. Their strategy is a straddle, buying both the call and the put same strike and expiry, with total premium of $17.04. At 256, both legs are out of the money with a loss of $5.54. The verdict at the actual 256 expiry, the protective put was winning strategy, nearly break even with full downside protection in place. The other 2 strategies resulted in losses. The takeaway is, instrument selection must match your objective and your position. Context defines whether a derivative hedges or speculates.
Thank you for having us at this board meeting.